Well, good morning and welcome to episode 101 of the Meet Kevin Report. We actually tried this yesterday, but yesterday we had some big problems. Hopefully today we do not. So we are back. Hopefully everything's going great today, and we're going to touch on lots of different things. Today we're going to have unemployment claims again, which will be quite interesting to see if we're going to get anything different from basically what we've gotten for what I like to say is the last year. Because quite frankly, it feels like the unemployment claims have been so stable, which is a good thing. On one hand, we don't want people to lose their jobs, but on the other hand, the Federal Reserve might end up using that to just give us more of a Canadian style rugging. Like yesterday, the big deal yesterday was that we kind of got rugged by the Bank of Canada. Unlike the Federal Reserve, the Bank of Canada doesn't really care about giving us a big old heads up about what's to come, at least apparently, given that in practice, basically everybody was caught off guard. Well, 80% according to Bloomberg were caught off guard, and 2/3 were caught off guard according to Reuters. So either way you slice it, that's still 67 to 80% of the market was not expecting a rate hike from the Bank of Canada yesterday. And that to some extent is going to throw some cold water on these ideas that, oh yeah, the Fed's definitely going to pause in the United States in June. That's pretty widely what Jerome Powell has suggested. So I would say that since Jerome Powell has generally and relatively accurately forecasted the path forward, we'll probably get our path or pause. However, there's always this risk that for some reason they're like, yeah, the CPI data we get was too strong or whatever. Remember, CPI comes out on Tuesday, which will be quite important. Good old Nick T hasn't written an article for the Wall Street Journal for like 6 days, so I kind of feel like, where do you go, Nick? Are you like on vacation or something? We miss you, man. But he threw up a tweet yesterday kind of just talking about the Fed rugging. I always like to keep an eye on that. And beyond that, we are just waiting to see what the markets believe the Fed is going to do and then what the Fed actually does. So that gives you a little bit of catch up on that. Yesterday, we also got some craziness out of GameStop, which we'll have to touch on that. The fact that you can cancel your earnings call and fire your CEO all at the same day, like when you're supposed to have an earnings session, partly makes me wonder, did y'all think of this crap like last minute? What is this? Like maybe how about a little bit more planning, eh? Yeah, who knows? Who knows? Okay, so as far as statistics, though, right now, it looks like we're looking at an exact 2/3 chance of a pause in June and a 1/3 chance of a 25 BP in June. As far as July, we're looking at a coin toss as to whether or not we would end up at 5.25, so a 25 BP hike. It's at about 51%. Do keep in mind that adds together the odds, though, of a hike to some extent already in June. And that is why you also end up getting about an 18% probability that you just get 225 BP hikes. By September, we're sitting at about a 48% chance that we're still sitting somewhere at 5.25, so about a quarter we're higher than where we are right now. It doesn't seem like markets are widely anticipating anything more, one more hike. So it seems like worst case, we're looking at just another one more little hikey doodle, unless of course we end up getting data that would justify even more. Which again, all it would take is one hot inflation report, and I think the Fed probably will be more aggressive. And I think that's actually what the Bank of Canada gave us as somewhat of a precedent. Because look again at the Bank of Canada, and what does the Bank of Canada suggest? They say, well, we had to raise rates 0.25% after we had our long 4-month pause because, well, inflation in April started going up. And it's like, really? I feel like central bankers for years have been like, one report doesn't make a trend. Don't just pay attention to one report. You got one bad report in Canada, and the Canadians are like, that's it, raise rates. All right. But then again, you also have a pretty strong GDP outlook over there. So that in fairness is a little different from the United States. Anywho, obviously you've got this giant cloud of doom in New York. I'm supposed to go to New York today, which is very interesting given that it's basically like a wall of hell of air quality. And I'm like, this is not good. So yeah, it's going to be interesting. We'll have to figure that out. And then, of course, you've got this this excitement over, okay, well, inflation and Fed this month, but Kevin, what about next month in July? It's like, to some extent, I think this month might actually be more interesting because that summary of economic projections, which will come out after that inflation report, could probably give us a hint about pricing in July appropriately. As far as catalysts, we're a little soft on catalysts over the next 2 days here. We've got initial jobless claims coming out in about an hour here, continuing claims in about an hour. We're looking at 235 and 1.8 mil. And then we're looking really for maybe some European GDP data, but really the next big catalyst is CPI. We're still looking at that 0.2 month over month on headline. Core expecting that to be 0.4. Boy, the best thing to just solidify being done would be a soft core read, in my opinion. We get a soft core read, could be really juicy. That would be nice. Indices basically flat going into the AM. Matterport's advertising like crazy on CNBC all the time. Maybe I should stop going to the Matterport website. I keep going to their website. We've done some fundamental analysis on them in the course member live streams recently as well. I will say, how Matterport gets affected by AI is going to be quite fascinating. In fact, what blows my mind is there's this app. Let's see here. I think I have it. Yeah, I do. So there's this app that Ubiquity puts together, and it's called a floor plan mapper. And it uses augmented reality. It just uses Apple's internal LiDAR, and basically you could just kind of carry it around your home like this very quickly. I gave it to Jack, and I'm like, how fast can you make a floor plan of the house using the Ubiquity thing, which basically tracks your Wi-Fi signal as you run through the house or whatever. But it makes a floor plan, and when you point it at stuff, like I pointed at a wall or whatever, it'll label it wall, floor, ceiling. I mean, that's a version of AI. And that's not to say that, invest in Ubiquity. What it is to say is, well, dang, if you need to make a floor plan and you can do that quickly and so easily, what does that mean for Matterport? Obviously, we like the 3D modeling and that you get with Matterport, but how's AI going to affect 3D modeling in the future? I don't know. I have no idea. But that's one of the fascinating things actually about finance. It's one of the things that makes me so excited every single day is evaluating what the heck is AI going to do to us. I mean, it's remarkable. Yesterday, I was with Lauren. I flew to Texas, came back, we had our date night, and we're like, oh, let's do a little bit of a trip planning, and we just go straight to AI. And I mean, we were probably bickering for about an hour without the help of AI, just trying to like Google stuff. And within 20 minutes of just like refining, we don't want to do those things. We want to stick to this or whatever for some time in Canada. We got something pretty dang robust from artificial intelligence, which would be pretty incredible. I'll do a full lecture on that as another. I've got a few more lectures actually still in the pipe for the AI course, even though we've dropped pretty much all the lectures. There are some more that I want to add that I'm pretty excited about. Some things that I'm still on the fringes of using, and that'll likely be what we find with AI is that we'll just always have more and more AI lectures coming out, just updating you with, okay, here's the latest. Here's how to use it. Here's how to manipulate it, and it makes it really fun. So if you haven't yet considered that program, seriously, check it out. It's really, really good. It gets you lifetime access to those course member lives as well. And it's pretty inexpensive. It's linked down below. Maybe about 30% of people right now are looking at using Affirm or Klarna with it. But a lot of people just pay for it because it's not that expensive, and then you get that lifetime access. So check it out, like down below. So then, as far as oil, we're sitting at 73 bucks on the Western Blend and 77 for Brent, up about a couple percent over the last days here, about 0.6% right now for today. It's slightly moved after the OPEC cut, but I mean, if I'm OPEC, I'm like, my puts did not print. Short more, cut more. But there's a limit to cutting, because remember what OPEC is. It's a cartel, basically. That's like, all right, we're all going to agree to make less money so we can make more money. And that doesn't bode super well. Like, when you have a lot of inventory, you want to dump it so you can make the money. Make more money. Like, would you rather sell, I don't know, just to make it the math simple, would you rather sell 10 barrels at $75 and make $750 gross, or would you rather sell 20 barrels at $70 and make $1,400 gross? Being a little extreme, but when you think about these production cuts, it's not that desirable for companies to be like, yes, we will sit on our barrels. That's lame. You can only sit on so many barrels. I wonder if these like oil barons and stuff have like oil barrels sitting around their dining table because they're like, OPEC cuts, honey, we must get rid of dining table, and they just sit on oil barrels. It sucks. You don't want to do that. So when I hear about these production cuts, I'm like, this is stupid. I mean, really what it is, it's just market rigging, right? It's a rigging of supply and demand economics. It's a disaster. So AI is already a phenomenal tool, but I will tell you, it takes effort for you to use it correctly. And there are a lot of things that are a toy. There are a lot of things that are great tools, but there are a lot of things that aren't even worth mentioning. I mean, there are, out of like probably 1,000 different AI tools and apps and ideas that we looked at, we boiled it down to like, here basically the best 35 ideas for you right now, and we'll keep adding to it. But we just don't want to waste people's time. Oh, look at this one. It's ridiculous. It's just, here's the best. That's how I like to operate my business. I mean, like, think about it. Do I really care if there are 500 different customer resource managers? No, just give me the best one. That's all I really care about. Worth keeping that thing in mind. But don't touch my oil. Okay, so somebody here says, don't come to New York. What is it with people telling me not to go somewhere? Oh, you're actually being nice. Okay, I live on Long Island. It's bad, Kevin. NY smells like the burning embers on a fire pit at 3 a.m. See, but that sounds fun, man. Like, is there beer? Just kidding. No, that actually sounds terrible. Yeah, and it's a little problematic because Lauren's got asthma, Jack's got asthma, Max pretends to have asthma, even though he doesn't. Just like he pretends to get COVID when everybody else has COVID. He doesn't get sick from COVID. I've, knock on wood, I haven't gotten COVID yet either, at least that I'm aware of. So, yeah, we'll look at Neo with course members today. We were going to do that yesterday, but after I basically had to take a giant hammer to my network, we're good. I actually think I got to the bottom of what the problem is. And it's really insane. But if you have networking experience, you'd be like, okay, there's a potential, Kevin. There's a potential. But I'll tell you, I tried everything, and I think I figured it out. I think what happened is I added another wireless access point using some old wiring infrastructure in the house. And I think when those cables were wired, the terminations at the end of the cable were manually done. They weren't manufacturer terminated. I think somewhere somebody screwed something up. And I think if a twisted pair is backwards or just a bad connection or something, maybe it's creating so much interference and resistance, it just like bogs the network. I don't know, but I just can't get to the bottom of anything else. And I'll tell you this, the modem's on bridge mode. The modem works fantastic. I reset the router, and I plug in only wireless access points that are run with brand new Cat 7 cable, no problems. But it all has to be like system reset, to restored to actually make that function. And then I have no problems. And so right now I've got 2 wireless access points, and I have better internet running than when I had 7 wireless access points using some of the legacy cabling in the house. Just pretty insane. You'd think the Ethernet would be reliable, but that's the only thing I got to the bottom of. Anyway, I kind of like this kind of stuff. It's therapeutic for me. Anyway, not that I need therapy. Nah. Look at gold. It's at 1960. You know, that just can't get it up over 2000. It's pretty wild. Then you've got crypto. Yeah, obviously a lot of drama circulating around Binance, as well as Coinbase. You've got Cathie Wood, who added a lot more to Coinbase, making the argument that, well, Coinbase is going to win because Binance is going to get screwed. It's actually a good argument on one hand, because if people are too afraid to have their money on Binance, they start withdrawing their money from Binance, and for some reason they want to be on exchange, could be a good argument. But you definitely have a cycle of regulation to get through first. And right now there's plenty of fear, uncertainty, and doubt, and it's relatively legitimate too, because if the SEC is on a quest to just destroy these platforms to preserve the dollar, it's not good. It's not good. Yes, I do have an interview with Ron Paul, and I will be posting that interview with Ron Paul. It's fantastic. Install Mesh Network. It's the best. I think you missed the point of me saying I had 7 wireless access points. That is Mesh Network. sorry. I had to. All right. All right. New business idea. Deli meat called Meat Kevin. Hey. Now you're just making fun of my old business. BTC more of a threat to the dollar than gold. That's why the government will come after BTC. I don't actually disagree with you on that. I mean, when you look at the last interview from Gary Gensler, I think it becomes exceptionally clear that there really is a fear about losing control of the monetary system, and they don't like that. Now, I'll tell you, there's nothing like talking to Ron Paul when it comes to the fear that the deep state is controlling everything. It's so fascinating. So I'm very, very excited to post that video. The SEC has 5 days to respond to Coinbase. Why they're not giving them any guidance? That makes it sound like things are going to go well for Coinbase. Don't worry. The SEC will reply. And then it'll have to get litigated. It always goes to litigation, folks. Speaking of which, we've got about 5 applications now for the first ever in-house attorney. But that does mean there's still an opportunity for you to apply, or maybe you know somebody you could recommend. Send them over. You have them emailed jobs@meetkevin.com. You do not need experience. In fact, the less experience you have, the better. You just need to have graduated law school and have a bar degree, be bar licensed, JD degree, bar license. The reason we're looking for somebody with as little experience basically as possible is because we want to grow with you, and we don't really need to leverage. It's not like here's caseload. It's going to be let's learn it together, because we're going to be in various different realms, and a lot of them are going to be sort of new frontier. So we kind of we're really into the it's like what Barbara Corcoran said, like we'll mold it together. So anyway, jobs@meetkevin.com. If you know somebody just needs a JD, you could always get bar licensed, I suppose, in Cali. You have to be local though. None of this remote crap. Okay, no. Don't bother. Need not apply. Have to be willing to relocate. Obviously, benefits, all that kind of nonsense that a typical company would offer. We will beat. We give better benefits. So yeah. And okay, good. So now what I think we ought to do now is let's go to I want to look at what's it called? GameStop. a little bit more in detail. So give me a moment here. I'm going to pull up some docs. And what's sports washing? Hold on a sec. And let's listen to this just for a sec.
His goal when he came in, let's before anything happened with Khashoggi, was to reverse 1979. It was started in 1979, ended in 9/11.
I have no idea what they're talking about, but how about that? That is, I just changed the channel. Oh, I hope it's working. What if I didn't set it up yet after the Wi-Fi problem? Oh, oopsies. Oopsies. Let's see if it ends up coming up. Anyway, that was supposed to be Bloomberg, but Bloomberg's on Ethernet. I'll figure it out. Oh, that's even worse. I basically unplugged everything. Okay, whatever. So worry about Bloomberg later. Okay, let's go to GameStop and let's see what we've got for good old GME here. So what we'll do is we'll go directly to the GameStop investor relations earnings release. And what we've covered GameStop quite a few times in the past. And I generally, I mean, I don't want to sound negative, but like I've been pretty dang negative about the company. I've kind of poo-pooed it a lot. And that pisses a lot of people off who are like, GameStop can do no wrong. Kevin, you don't understand. They're getting into legacy game. Like, no, not legacy. What would you say? They're like, you know, when I talk about GameStop, people generally like, Kevin, you're a boomer. You don't understand. They're going to sell collectibles. They're going to sell NFTs. And I'm like, you're still investing in NFTs. You're stuck in 2021, first of all. And second of all, they were a scam then, and they still are now. But anyway, let's look at GameStop in detail by looking at their press release and figure out what's going on. In the meantime, their CEO for the past 2 years just got bugged. The shares are down like 21% in the pre-market. Ryan Cohen is taking over as executive chairman. He was already on the board. So really, they're just sort of like retitling him as basically some form of acting CEO. This is the idea that, okay, well, you know, if he can handle setting up previous startups and internet companies, then he could save GameStop, this legacy company that I actually have a lot of great memories with. But we've just had a lot of problems with the GameStop numbers that have been coming out. I remember the last time I covered GameStop, we were covering, it was 2 months ago. That well, I mean, technically it would have been about 3 months ago. But we were covering GameStop, and people were freaking out about the inventory situation. And so before we look at going into the new report, this was the last report ending January 28th, which was my birthday. Digital asset impairments. They took a $34 million write-down on digital asset impairments. Basically, they're like, all these NFTs we thought had value do not. Oh, no. We will have to write them off the balance sheet. And so they did. And then I made the argument. I go, well, this is interesting. Merchandise inventories on the cash flow statement are positive. That does not mean buying inventory. When the number is negative, it means you spent cash on inventory. When the number is positive, it means you sold through your inventory and you received more cash than you used to buy. People totally misunderstood that. And so, in other words, the company's trying to increase their profitability by just selling the crap they got, and they're not buying as much new stuff. It's like maybe they went through some COVID surge, and here in the last report we know that but Carvana, they're supposed to be a collectibles company, and then it's like 16% of their revenue is collectibles. Do you really want to lose 80% of the revenue just to grow the 13%? Like, you just don't need to go to GameStop to buy software anymore. I mean, Amazon alone was a problem when it came to hardware and accessories. But boy, and don't get me wrong, I miss GameStop. GameStop was the first job I dreamed I could have had. I applied to that freaking GameStop in the Sawgrass Mills Mall, which was one of the top 5 busiest malls in America. I applied to that freaking GameStop like 17 times and they never hired me. So maybe I'm just bitter, okay? But before we go into these financials, I need you to know that. I also need you to know I was there for the midnight release of Splinter Cell Chaos Theory. I was there for the midnight release of The Burning Crusade. And I'll never forget those midnight releases. So don't take that crap away from me. But when it comes to the stock, it sucks. And I'm not bitter. Okay, maybe a little bit. Maybe a little bit. But anyway, they had cash and marketables around 1.3 billion. The payables were pretty high, also around 1.1 billion. Yes, payables are technically not debt because all the haters were freaking out. They're like, no, you can't do that. That's a bill. It's not debt. So, okay, call it what you want. It's still an expense, you dummy. All right, let's now, with all that aside, let's do a quick, a micro fundy of the latest statement. And let's see what the latest crap says at GameStop. And let's see if the latest crap has actually gotten any less crappy. How about we just start with the cash flow statement? So we go to the cash flow statement for April 29th, and for the 3 months ended, we're negative 50.5 millis. That's net loss. Net loss, negative 50 millis. Operating activities, negative 102 millis. Capital expenditures, around 9.1. So we're negative about, I'm going to do quick rounding math here. Don't make fun of me for rounding. Minus 110 millis in free cash flow. Not great, especially since we kind of had a match of bills to pay in cash the last time around. So not great. Here, take a look at this beautiful line they put in here. Ready for this? Gain on sale of digital assets. You ready for the gain on sale of digital? Oh, 0. Okay. Well, what about previously? Oh, the gain on sale was negative. Oh. Yeah, I'm just going to ignore that one for a moment. Then we've got merchandise inventories. Finally, they actually acquired new inventory. Good Lord. Finally, they bought some junk. $83 million of trash to sell at GameStop. Fantastic. Look, they actually generated like a reason for existing. Imagine that. A store buying inventory. Okay, here, what do we have for sales? All right, so we have net sales here and cost of sales. Okay, let's do some quick math here. So net sales at 1.237 billion divided by 1378. That's going to put you down about 10.3%. And then your cost of goods sold decreased by a rate of 11%. So that's roughly in line, actually about 12%. So that's good. That's actually a little bit of a margin improvement here. Gross profits, relatively similar, though clearly negative here. The OPEX, very nice decline. I will give them a very nice decline here in OPEX, although and it depends if they count their in-store employees as part of cost of goods sold or as part of OPEX. But I'll tell you, yesterday I made the terrible decision of actually walking into a Dollar General. I walked into a Dollar General in Texas, and this place was a disaster. I mean, unopened boxes everywhere. It was disgusting. There was one employee for this massive store. So you had like a 10-minute line to check out on nuts. And I'm like, this is nutty. It's crazy. Now, the good thing was I had nothing else to do during that time because we were taking apart our studio set for Ron Paul's interview, since we did that in his office. But my gosh, if you want to just like rip off your customers, just fire everybody from the stores and have like one person. Now, I know that's Dollar General and not GameStop, but go to GameStop. They're pretty understaffed too. So anyway, so you got this loss per share that's actually not as bad as it was last year. Your share count hasn't really moved that much, which is good. It's not like they're continuing to dilute shareholders. Long-term debt, 23 million, which is very little. I generally don't look at lease liabilities. I consider that more of a cost of goods sold or an OPEX. So then we've got payables and current liabilities here. Still got about 1.1 billion right here. We'll go ahead and call that 1.1 billion. And then we've got current assets. Remember, your negative free cash flow, but you're still sitting around about 1.3 right here of marketables and cash. And then you've got inventories here, still much lower than what you had, about 15% down from last year. But actually a growth now from January, given that they're giving you the January numbers here. Here you can see that cash has gone down by about 70 mil. That's because, they've started paying down some of their bills over here and increased their inventory. I will say the numbers actually here don't look that terrible. So this isn't like that scary of a change of information. And collectibles, let's see here. Really? Usually they give us a percentage. Let's divide that. 173 divided by 12. Oh, unless I wrote that last time. Okay, so collectibles went down to about 13.9% in collectibles. What was it before? Before, collectibles were sitting at, let's see here. 16.3%. So collectibles are actually falling as a percentage. So all the people that are like, the collectibles business is going to the moon. It's silly and nonsense. But actually, I will say these financial statements aren't like that horribly deteriorated. I'd say it's probably more of a red flag that they canceled their earnings call and you have the CEO transition, because it's a sign that the CEO's transition to being more efficient from an operating point of view is actually not functioning anymore. In other words, you had somebody who killed the low-hanging fruit of being able to cut those excess jobs that they had. But after that, they can't transition the company to revenue growth. That's probably what this is. So my assumption is that the GameStop board is realizing, and they probably, honestly, they have to know this. You can't be a moron. You have to know that this is a dying business. And the bull narrative on GameStop is that the board and Ryan Cohen are somehow going to magically be able to take a Sears and turn it into an Apple. And first of all, it's totally idiotic to think that's going to happen. Worse, to bet your money that that's going to happen, but okay. But let's say it does happen. You're making a massive uphill bet. And what you need is really good executive leadership. So now it's on Ryan Cohen and the board to find a CEO that I can actually transition this company and can make a difference. And this firing and canceling the earnings call, to me, sounds like, what they probably did. And this is just my guess, okay? But probably what happened is a phone call happening. Boys, girls, it's Ryan. How are the numbers this quarter? Did we get the R's up yet? Did we get the revenues up yet? Ryan, it's bad. Things aren't going good. We ran out of stuff to cut, and it's all basically going to look flat from last month. He's be like, bug the CEO, fire him, find someone else. We need to show the world we're still working on our transition. I'm going back on my yacht. I don't obviously know that, but that's my guess. Is it probably went something like this? We need to show the world we're transitioning. Very uncertain stock to play. And really, I mean, think about all of the startups that are competing with GameStop that don't have all this legacy crap and these locations that are partly in bad locations, and this all these legacy systems that are designed for selling you, used and new CDs or games or whatever. Transitioning this to some kind of new asset like collectibles, which the sales for continue to fall. It's just, it defies logic. So whatever. Anyway, that is my thesis on GameStop. It is exceptionally bearish. I mean, I'd love to see someone's bull narrative on it. But then again, sometimes the downside of making a video specifically on one stock is that only people who really want to invest in the stock watch the video, and then everybody else doesn't watch that video. And so that means you only have the bulls. And if you're a bear, it actually hurts you because you're talking just to the bulls. And it kind of discourages actually making negative videos about things, even though they might be reality. But I don't care. So now let's talk about something else. GameStop could survive if they focus on quality products with an easy online purchase path. Amazon is full of trash people who don't want to search through. What? Amazon? You mean products, like trash products people don't want to search through? I mean, first of all, let's talk about what you've just established. You've suggested that because people are too lazy to scroll on Amazon, and you're suggesting that Amazon's results algorithm is so bad that basically GameStop should become Amazon. Guess what I would say to that? Let's assume they succeed. Congratulations, you're a money-losing fulfillment website. That's why I don't invest in Amazon, because the worst part about Amazon is what I use Amazon for. The worst part about Amazon financials is Amazon.com. Fulfillment and faster delivery and returns and dealing with all this inventory shit is a horrible business to be in. It is a horrible, not profitable business. They will continue to invest in fulfillment until they can teleport this crap to your living room. And that's going to be a while. It is not a good business to be in. So if you're saying the best thing that GameStop could look forward to is being Amazon at the part that I hate of Amazon, well, you've reiterated to me why this business model sucks. Sorry. And it's somebody else. Sorry, I got this giant naked picture of Ryan Cohen that popped up, and it just took the entire screen up, and it just like destroyed the stream. Oh yeah, here's the Max is pointing out the real thesis for investing in GameStop. You ready for it? High short interest. Let's squeeze the suits by investing in a trash company. We'll get them. Oh, Kevin, you're just a suit now, because when you list an ETF on the New York Stock Exchange, you're clearly bought out by the deep state, because nobody could do that unless you're part of the deep state and also a suit. Even just saying that doesn't even sound logical. It doesn't even merit a response. But Kevin, Jeff Bezos is rich. Dumping stock on the normal people is a great way for these massive institutions to get rich. You're right. Anyway, so I think that about concludes our rant on GameStop. And now let's, I don't know, which button is it? Is it this one?
Gain the lead.
Yeah. Kevin was getting close to the truth of teleportation at Amazon and then gets cut off. Yeah. All right. Now, who knows? It's all just opinion. Don't sue me, bro, okay? Oh, I should have brought it in here. Somebody gave me a hard hat yesterday. Actually, I have a picture of it, which was kind of cool. They gave me a hard hat, and the back of it says "Don't sue me, bro," and the front of it is a stock crash proof helmet. I'll have to pull that up in just a second here, but you know, that's only when AirDrop functions. See, now if I had a Dell, I could be emailing myself this photo and actually it might show up faster. Although they started getting like, wasn't it like Android drop or something like that? Like, oh yeah, I'm losing business to the iPhone blue texters. Let's Android drop it or whatever. I don't know what they call it now. I went into a Samsung store and I saw it. But anyway, here's Jack with his crash-proof helmet. See that? No stock decline over here. All right. So sky high New York rentals. What are you yapping about?
So maybe it's not, maybe the top isn't
issue
100.
Still is not, I mean, maybe if you're living in Manhattan and you're 5, 10, 20 minutes away from your office, but we're also talking about Brooklyn and we're talking about Queens.
That's right.
And we're talking about
And Jersey City rents are way up too.
Right. We're talking about Long Island City. All of
everything
that's
around New York.
But all of a sudden, if the commute becomes, people talk about now earning your commute. If the commute is not 20 minutes, but it's 30 minutes, 40 minutes, 50 minutes.
Yeah.
A lot of folks are saying, I mean, the other day I was supposed to do a meeting downtown. It would have taken me half an hour.
Yeah.
The other
Try
guy
the subway.
I don't know why we're talking about this. This is boring. Sorry, CNBC. You're being boring. So what else is going on? It looks like EXPI. It's actually up like 9%. That's a little bit of a shocker. Volumes are so down. So what's for real estate sales? But then you wonder, it's like, well, is the worst priced in? So that's the beauty about stocks, is by the time things get better, it's already priced in. So EXP, let's see what the drama is. Oh yeah, here we go. Okay, yeah, this is the reason to invest. EXP introduces AI-powered chatbot to support agents. Okay, the median age of real estate agents is like 55. Let me tell you how much they're interested in an AI chatbot. Wait. Survey says 0. Jeez Lord. No, it's actually because EXPI is gonna appear in the S&P 600. Ooh, the S&P small cap. Let's join the index and pump the value of the stock. That's stupid. Dude, Gordon Johnson, stop tagging me, man. Gordon Johnson's tagging me. He's off to tagging me again on Twitter. It's fine. I think Gordon's a nice person. He was really nice in person. And just because he's a bear doesn't mean he's a bad person. And Gordon Johnson says, if you or anyone can show me why/how Bitcoin is worth $26,000 a coin, I will immediately change my view. For instance, company A is worth $20 a share because they will make $1 next year and grow at 20% every year for 10 years. So $1 times 20 PE equals $20 per share. Show me the math on Bitcoin. I mean, it's not wrong. I mean, that's the traditionalist argument of evaluating a company. But come on, man. This is digital gold. You can't put a price on gold. It's priceless. All right. So what? Oh, Eurozone slipped into recession in Q1. Oh, did we just get the European numbers? I've been waiting for that. Let's look them up while we listen for a moment.
Meantime, I want to go over to Dom Chu. He's got a look at some of this morning's top pre-market stock movers. Dom.
All right, so Andrew, the big news of the morning on the stock side of things is the plunge, an absolute plunge in shares of GameStop right now. The video game retailer is down about 21%, and it's been just about there for the last hour or so. It's ousted its CEO, Matthew Furlong, and named activist investor and Chewy founder Ryan Cohen as executive chairman. Now, the news came as GameStop did report a smaller than expected quarterly loss from the same time last year, while sales, though, still declined. And by the way, for those interested in more on that GameStop story, check out CNBC's new documentary on Ryan Cohen called Making the Meme King. It's available online right now on CNBC.com as well as YouTube. So keep an eye on GameStop shares down 21%.
Yeah, whatever.
Let's move across to the Pacific and the Chinese auto business, especially the electric vehicle makers. This on news that the Chinese Ministry of Commerce will kick off a campaign to try to promote auto purchases among its consumers, making credit more available for some of those purchases, as well as more programs to help support vehicle owners. Some of the more well-known China EV makers and Tesla are on the move, perhaps because of some of that bit of news. You can see NIO, XPeng, Li Automotive among those showing some signs of life here in the pre-market trade. And then we'll end with the casino operators. Speaking of China, Wynn Resorts and Las Vegas Sands, both down pre-market. There's a pickup in trading volume so far, but one of the reasons for that weakness could be analysts over at Jefferies who've downgraded both from a hold to a hold from a buy. Wynn also goes price target-wise to 114 from 135. Las Vegas Sands is down to $65 from $69. They said that the Macau recovery, speaking of that Chinese market, is already priced in these stocks. So as you take a look at Andrew, watch Wynn Resorts, Las Vegas Sands, and those Chinese EV makers. I'll send things back over to you.
Hey, Dom.
Dom, thank you, man.
Dom, I bet you feel pretty stupid turning down that live golf money at this point, huh?
I think
you wish you had said, I mean, you know, all your principles, trophies, history.
I love how blunt this guy is. Anyway, so yeah, well, here's just we'll just look quickly at this NYT piece. So here's your well, I call them the NYT because the emotional people don't know what that is. And the smart people are like, okay, it's the New York Times. I understand. Yeah. Okay. So anyway, so the news. Eurozone slipped into recession earlier this year amid the shock of high food prices and energy prices. Europe's statistics agency reported Thursday, whatever, shallow downturn reflected challenges the ECB is facing. Who cares? Growth in the 20 nation group, in the 20 nations that used the euro, rather, declined in the first 3 months by 0.1%, revised data showed. Yep, there it is. 2 quarters, Q4, Q1, negative, boys and girls, negative. All right. You ready to see what this beautiful recession is doing to the stock market? Well, if you've been watching for the past few days, you already know. The DAX, and this is your Dow 40, basically, of Europe, or rather of Germany, is positive today. It's positive the last 5 days. It's positive the last month, not by a lot. It's up 12% the last 6 months. It's up 13% year to date. On the 1-year chart, it's up 10%. On the 5-year chart, it's up 25%. And the max chart, it's basically knocking on the door of all-time highs. You're within like 2% of all-time highs. So in other words, this, Europe slipping in recession issue here is clearly really hurting. You know what's actually kind of funny? I was thinking about this yesterday, and I'm like, if the DAX is making all-time highs while in a recession, but stocks fall when inflation stays sticky, then how about we purposefully go into a recession in America? It'll be great for stocks and it'll kill inflation. Yeah, I don't do leveraged ETFs. I think leveraged ETFs are very, very dangerous. Leveraged ETFs are for daily trading, but fee-wise and potential long-term return-wise, the leveraged ETFs can be very, very dangerous for either getting margin called out or basically creating impossible returns during a market, depression or crash. It's scary. I mean, just look at this, for example, okay? Let's say you have $100 in a leveraged ETF and $100 in a non-leveraged ETF, and the stock falls 30% on the non-leveraged, and then you have a 3x version of it. So it falls 90%. So one of them's worth $70, the other one's worth $10. Now, let's say the $70 one doubles. Okay, so now it's worth more than what it was before. It goes from 70 to 140. It was 100. So it's up 40% from what it was before by doubling after its 30% decline. So it doubles. Okay, now basically you would take the double times 3. So double times 3 would be 6x, the $10, and you're at $60. So the non-leveraged one's 140, the leveraged one's at $60. Well, that means the non-leveraged one's up 2.3x. Now, obviously, that's just an example of like how it could be really bad on a 3x leverage, right? But that concept is something that you should consider. And over the long run, it seems like on the leveraged ETFs do not see like a substantial outperformance. And that's likely because the downturns are just that much more painful. And as a result of that, and the lack of being able to rebalance, because if you have a lot of exposure to one leveraged ETF and then it does well, as soon as you try to sell out of it, you're going to pay the big taxes. If you were in just one ETF that could rebalance for you and potentially avoid paying taxes via the benefits of what ETFs do, well, geez, then you don't have to, pay as many taxes potentially, which is pretty exciting. So I don't know. For me, that's my argument against leveraged ETFs, and I'm sticking to it. So, Yeah, we've actually analyzed Toast and Dutch Bros here. You know, the cool thing about the course member lives is you get this like archive of all of the previous lecture sets that we've done and fundamental analysis. And it also gives us an opportunity to really go back and go, okay, well, what was our opinion and how's our opinion changed over time, which is also great. So, did you see BBC or? Yeah, you know, it's journalists have for a very long time, unfortunately, thrived on having to make statements that are very, very, you know, clippable in interviews, and unfortunately, you know, in certain circumstances, that just plays out horribly for them. You know, and when that gets pointed out, it's pretty brutal. But yeah. Okay, so what else? Let's see here. You use 3x to hedge. Yeah, that's an option, you know, because if you're hedging, you're basically trying to buy yourself an insurance policy, and you're either going to write it off as a loss, or you're, you know, you're willing to take the gain on it. So, anyway, what else is moving here? Oh, Carvana. Look at that. Carvana up at 20%, just all of a sudden. A little bumpy in the last 10 minutes. Carvana has just started, you know, doing some little movie doodles here. Let's try to figure out why. And then in 19 minutes, we're going to get those continuing claim numbers. So we'll take a peek at that. And, oh, here we go. Oh, Carvana just reported. Oh, that's a shocker. All right. Let's see here. Carvana. So Carvana sees Q2 sequential reduction in retail units. 2Q loan sales, 2 billion sold or securitized. Q2 adjusted EBITDA above 50 mil, saw positive adjusted EBITDA. Adjusted gross profit per unit at $6,000. They saw just above $5,000. That's good. They're actually making money again on their cars. That's great. I mean, they were expected to go bankrupt. Improved 2Q financial outlook. Liquidity will continue to erode, though, over the next 12 months, with the potential for basically another money raise. Yeah. Good old Carvana. All right. Let's keep listening over here. What else is there?
Most investors is that we're closer to the peak than the bottom. And so what that does is give you room to begin to stretch out your duration discussion. But we're probably still looking at a higher rate for longer backdrop over the next couple of years. That's not a tailwind for valuations from here necessarily. So we think we're stuck in this trading range is really about, yeah, earnings are resilient versus what we thought they might be in a recession condition, but rates are probably higher. And you're still kind of left with what's the fair value for the S&P. We put it right around 4,000, and that's where our trading range, a couple hundred points on either side of that comes from.
So you better find really good stocks, I guess. But maybe you can start adding the positions at 4,000. All right, Scott Croner, thanks. Appreciate it.
When we come back, tackling the critical issue of protecting children in the digital age. After a break, we will speak with Facebook's former chief security officer about a damning investigation into Instagram. And check out shares of Carvana, the auto retailer upgrading its current quarter guidance of an industry conference today. Check out the stock. It's up 25%, a gain of almost $4. Stay tuned. You're watching Squawk Box, and this is CNBC.
This is meat, Kevin. Losses on meat leave investors with a sour aftertaste. It's an interesting article title we got here on the Financial Times. Look at that. It's Beyond Meat. Who remembers the tattooed chef? Me too. Anyway, biggest single trend in the history of food. You know, I always thought it was very interesting. It's like I remember being a kid, and it was like we had like soy burgers, and they always taste like crap. And I've tried the Beyond Meat stuff before, but boy, I don't know, man. Like, let me put it this way. When I think about a Beyond Meat burger, I'm like, all right. I guess those are calories. And then yesterday, I had a double cheeseburger in Texas from McDonald's. And it was like really good beef with the onions in there. and a couple French fries that while you're chewing on your burger, you're like, oh, give me some of those too. It's so good. Sorry, man. Like, I want my beef. I want my patty melts. I want my prime rib dip. I want my Red Robin gourmet burger. I don't want your plant crap. I eat enough of that already. I eat fruit like all day long. But when I want meat, that's meat. Meat Kevin, after all. Come on. But anyway, okay. So that's pretty boring. There's got to be something else going on in the world, right? Of course. Lionel Messi. Is he going to go to Inter Miami? Giving up lots of Saudi money. I don't know how many people are interested in sports. What is this? C3AI. Ooh, here's an opinion piece on C3AI. Now, I have a negative outlook on C3AI, so I'm just going to reveal my bias up front. But you were in Texas and went to Mickey D's. Hey, man, come on, man. Like, where I was, there was nothing, okay? When we flew out of wherever I was yesterday, it was somewhere outside of, like, Houston. When we flew out of there, I was, like, looking at the homes out there, and it was, like, home, like, 20 acres, home. It's like, if you want to go trick-or-treating, you need a Tesla to get you from, like, house to house. And that's great. There's a lot of space, but let's just say there aren't a lot of great options. And I had to get back for date night, all right? You got to be on time for date night. Very important. Do not screw that up. All right, so where were we? C3AI. Car for Coin says he's ready for an impromptu interview. For what you want to talk about BTC? Anyway, here. C3AI. Not every AI company is a growth stock. There's a disconnect between the hype and how it's going to ensure a sustainable source of revenue. Actually, this is a fantastic statement right there. I do not believe most software companies can prove a sustainable source of revenue. I actually think that most of the moats for AI companies, especially software companies, are zero. Like, there is no moat. AI is the hottest sector of the year. Who cares? Ticker AI doesn't help, doesn't hurt. Revenue growth is expected to be about 14% this year at best. Totally agree. Like, you can't invest in this company. What else here? Pivots are lauded in Silicon Valley, but the company spends a lot bringing in new customers. Well, yeah, and 30% of or actually it's like 30 to 40% of their revenues come from one person or one company, a legacy, sort of like energy. I can't remember what it is. But anyway, small number of customers account for a large proportion of sales. 3 made up 40%. There it is. Baker Hughes accounted for 45%. Yep. Joint venture will end in April 2025. Now that it's moving to a model that charges by consumption, revenue could become less predictable. 110%. That's actually a great opinion piece right here on C3I. Just a quick little outlook at some of the risks. What's this IG stuff they keep talking about here?
Hard to guess. I'm not going to say any on the air, but tags it.
Kevin, you predicted GameStop last earnings report. And thank you. Thank you for pointing that out. I very much appreciate it.
Of sellers who are connected to one another, who then the algorithm that Instagram has shows them and introduces them to more potential sellers of this material. So it is a real problem, and it is something that we have told Instagram about several weeks ago that they've started to address, but it really is a huge issue there.
How long has it been going on?
Well, this has probably been going on for at least a year and a half for this specific network. That's about the age of most of these accounts. Few of them are more than a year old. It's hard to know exactly how long that this kind of exact thing has happened on Instagram. But these specific accounts some of them are about a year old. What happens is if sometimes they get caught, if Instagram takes one down, they reinsert themselves in the network. And so that's one.
Take one down, pass it around.
A coalition of sellers of child abuse material who then, if somebody gets kicked off and they come back, they will welcome them back into the fold. They will follow them. They will promote them. And then the algorithm and the way the hashtags and search work on Instagram reintroduce that seller to thousands and thousands, tens of thousands of willing buyers.
Axel, let me ask you a very pointed question. Given that you used to work at this company and given that you've raised questions at times about Meta and their security and their management, either about looking the other way at certain things and other things. In this case, are you suggesting that they knew about this and looked the other way? Are you suggesting they've been acting in good faith, trying to eradicate this, and it's a problem that's almost insurmountable insofar as these folks popping up left and right on their own? Judge this for us.
So it's definitely not an insurmountable problem. Getting rid of everybody doing anything bad on Instagram, that's impossible. Not allowing people to openly sell child abuse material, some of which is not just naked photos and such, but some really, really horrible, terrible content. It is totally possible. And I think what's happened here is that Meta has really focused on AI and automation as the backbone of their content moderation strategy, of what we call trust and safety in the industry. All
right, this is so freaking boring. I can't handle it. I just can't. We're gonna look at something else. We'll take a very, very brief look at this like liquidity drama. Okay? And I'm gonna give you the shortest explanation ever on the liquidity drama. And you have to like the video for a good condensedness of a topic. All right, one sec. So the latest bear FUD is liquidity and the Treasury General account needing to be refilled or replenished. In fact, here's even our boy Nick T over at the Wall Street Journal, who still hasn't responded to my request to interview him. Maybe he's just not into the meat. Kevin. But anyway, so the Treasury Department provided a little more detail Wednesday on how it plans to refill the Treasury General account, carefully following the latest debt limit solution or resolution. The Treasury now expects that its cash balance will be about $425 billion by the end of June. Basically, what this is when the Treasury has no money left, it's got to fill it back up. And it does that by issuing IOUs called bonds. Now, when you hear about bonds, I just want to be very clear. Replace the word bond with loan. And I promise you it will make a lot more sense when you think about it that way. So, to draw it out, it's basically, hey, the Treasury's like, yo, we need another 400 billies. Okay, how about you just issue like a whole lot of these $1,000 notes? And instead of calling them a note, we'll just call them a bond. Okay? Roughly similar. For the point of this, it's good enough. Okay, and so we're going to issue debt. The point is, somebody has to take cash out of their bank account and give it to the Treasury Department, right? Because if you've got, let's say, Kevin, and he's got his bank account right here. So here's Kevin's bank account, and I'm going to go minus 1,000 over here. The Treasury is going to get my $1,000, and I'm going to get this piece of paper. So I could go, ooh, look at me. I have this note. I have this bond, and I'm going to put it on my balance sheet. And the fear is that this is going to lead to some kind of liquidity drain, because then Kevin's going to be able to spend less money on fuel to go fly around or whatever it is that he does with his dollars. So that would be concerning potentially, because that could mean less earnings per share for companies, right? Potentially, if the money comes from Kevin or businesses or corporations. If the money comes from the reverse repo facility, then it might not matter at all, and you might see no impact at all. Now, to explain this in a more sophisticated manner, and then to explain the implications for the stock market, let's look at the way Citibank explained it. In simple words, the last paragraph is here what matters. For reserves, it matters who buys the bills, which are like short-term loans. The Fed's reverse repo facility sits at a $2.1 trillion cash balance, with money market funds consistently making up about 90 to 95%. If they are enticed to buy the T-bills and earn the yield, the impact on draining bank reserves could be modest. So in other words, if we use the reverse repo facility to buy these bills, then maybe it doesn't really matter. However, if corporations step in, or small businesses, or overseas buyers, or whatever, then that's potentially less money that's going to end up going into the stock market. And that could create a headwind for equities, as Citibank suggests here. Now, one complication here, which actually feeds into the bear narrative, is that, but Kevin, if you're earning 5% on the reverse repo and you're getting paid out on this every single night, 1/360th, because the banking calendar is 1/360th of the year. So you're making 1/360th of 5% every single night. And you basically have, pure liquidity here in the reverse repo facility. Why would you bother putting money into like a 6-month treasury bill? Well, the reason you'd want to put money into a 6-month treasury bill is because, surprise, surprise, you get paid a premium. Well, what is that premium? Well, right now, it's about 44 basis points. In other words, it actually makes sense to move money from the reverse repo facility to the 6-month bills because you're going to make more money. Now, if you end up using these, or rather, if the 6-month T-bill market were only paying, let's say, 4.75%, and you had to lock your money up for 6 months, why would you do that when you could lock your money up for a day and earn 5%? But now, 6 months and earning 5.44, that actually looks juicy. So in other words, I don't know that it's really a big deal that the Treasury General account needs to be refilled up, because there's plenty of incentive, in my opinion, for picking up these 6-month T-bills and maybe moving out of reverse repos. So simply put, it's probably going to be a big, giant nothing burger. But the bears are still going to use it as evidence for why the market is going to crash, at least until they can come up with a better narrative, which they might end up getting, quite frankly, next week, because we've got CPI and the Fed coming up. In the meantime, here's the NASDAQ, and what it's doing in the pre-market is conveniently bouncing straight off my Fibonacci line. And if you want to check out a paid promotion and get yourself 12 free stocks with Webull, which is this app right here, you can do so by going to metkevin.com/free. Ooh, juicy. Anyway, so that explains that. All right. So, is the chat working? Yes. Ray Dalio is calling this cycle the big debt crisis. And then he's saying there's no debt or no buyer for the debt. What do you mean there's no buyer for the debt, Ray Dalio? When the debt is paying you 5.5%, there are lots of buyers for the debt. There are lots of people who are like, my hands are too soft and weak to buy stocks, so I'll just put them in at 5.5% and be happy with that. I don't care about the opportunity cost. Okay. So, anywho, that answers the liquidity crisis, hopefully. Curious to see a poll how many. Okay, I'd be curious to see a poll on how many people here are seriously interested in crypto investing. Well, I'll take you up on that challenge. We have 60 seconds to create this poll, and then we need to go into the continuing claims news. So, do you actually, let's just say, do you invest in crypto? Do you invest in crypto? Yes. No. Yeah, all right. Let's go ahead and just ask away then. We'll keep it simple. There's no bias in that question. It's just simple. Do you invest in crypto? Yes or no? All right. In the meantime, remember, check out those programs Building Wealth link down below, specifically the AI course. The lectures are out. We've got more already in production, which is very exciting. Let's go get those numbers. See what happens with unemployment claims and continuing numbers. All right, here we go. Continuing claims expected to come in at 1.802 million. Initial jobless claims expected to be 235,000. A bigger number of jobless claims would show a weakening of the economy. A lower number would signal a strengthening of the economy. And the numbers, which should be out any moment now, but they are not yet, will be what we talk about as soon as they come out. I can't keep hitting the table here because the numbers aren't out yet. They're still not out. What is this crap? They're 26 seconds late. Any minute now. Anyway, I'll let you. Did they get them before? Did they beat me? I still don't have them.
250 on initial. Which side of 1.8 million on continuing claims? I don't see them crossing the wires yet. Do keep in mind before we get the
didn't beat me. Oh, there it is. 261. That's a little hotter for initial jobless claims, but less continuing claims. 1.757. So fewer continuing claims, but more initial claims. So kind of like half, 6 of one, half dozen of the other. See if he responds to that yet.
61,000 on initial claims.
Yep.
Okay, you can hear those yields falling straight down. When was the last time we were up at 261,000? We have to go back to October 29th of 2021. October 29th of 2021 to find a higher level. And on continuing claims, the exact opposite. That's most likely going to...
The revisions were basically flat as well.
1,757,000. So definitely not above that 1.8 million significant level. 1.757 actually is the lightest level, probably going back to February, second week of February of this year. So it's definitely a bit of retrenchment there. Pre-opening equities, the futures are coming back just a bit. Very close to unchanged on Dow futures. And as I pointed out, down 0.1% Q4 and Q1 in the Eurozone. And everybody continues to talk about.
Look at the NASDAQ. The NASDAQ is like, hell yeah, bros. Hell yeah. We ain't got problems here. It was like I said, 6 of one, half dozen of the other. The fact that your continuing or your joblessness came in a little higher is probably, you know what it probably is? It's just the Fed. These are Fed bets. And because the initial claims came in a little higher and you had flat revisions, is a little bit of a sign that the Fed 5% is starting to bite. And it's just going to reiterate. I would bet that the futures monitor will fall. In other words, the odds of a rate hike in June will fall as a result of these numbers. That's my guess. So we'll see and that's exactly what's happening. The pause just got priced in by another about 4 or 5%. So it's moving right now on the back of this data here. So that's exactly what's happening is you're getting a little bit more pricing in of a pause because of those initial claims. But in terms of recessionary fears, people are still able to get jobs. So continuing claims are falling. So you're seeing the turnover, right? You're getting layoffs, but people are still getting new jobs. But that's the point, because that lowers job openings and brings the economy back into balance.
Something that we have to factor in. It had been very well behaved. You don't want to make too much of a single week's number. But then again, here we are going into the Fed cycle here next week. We have a meeting and it's pretty much a pause. I'll just double check that has not changed while I'm talking here, but it had been kind of 70-30-ish. It still looks like it's 70-30 for a pause. And now, now 75-25. So a little bit of movement right there. It just updated for me, and a 63% probability that July hike is a little bit lower. And I'm interested in the 3-month and the 6-month. Remember, those are the things we're talking about. One of the places, actually, the Treasury is also doing 6-week cash management bills. Those are the places where we're looking for that $1 trillion or so of bill issuance to happen, and whether or not that comes down a little bit. It looks like it is off in yield just a little. So we'll be watching all that stuff with the big question about the money markets, whether or not they choose to buy there or otherwise keep their money at the Fed in the reverse repo facility. So we'll see, guys, if this is the moment when we finally get the job market reacting to the rate hike. So far, one of the big strengths and one of the big counterpoints to the idea of this not a recession right now has been the strength of the job market. This is something this is a notable increase that we have to watch.
And we got Europe back-to-back quarter. But Steve, This will probably cause some distress for you too, but you know how recently we've sort of been saying the same things, like independently of one another. It's happened like again and again. So Ian Shepherdson's here. And when Rick said that, I said to Ian, this is the day we're going to remember the 2-6 that it happened. And I've said that like 10 other times.
Yeah.
Too, that this is the day. But I really meant it this time.
Make sure
this is the day.
Make sure Ian knows that I make sure Ian knows that I follow him and his skepticism I reported earlier this week about the Friday jobs number and his sense, which I'm very excited to hear about, this notion that I think he said this was the last good one, or that he expects the job market to weaken from here.
Right.
He may end up having been right. How is that for my grammatical use of tenses?
That's right. That's good. But yeah, I said it to him. He nodded. You said they should skip. They should take the summer off.
Yeah.
And they probably shouldn't have done the last one.
Absolutely, they shouldn't. No, I think all these people who are still saying, well, because of the jobs numbers, we gotta keep raising rates.
The lag.
Yeah, lags. Please, everybody, remember, monetary policy works with long and variable lags. They've only been raising rates for 15 months. They've hiked by 500 basis points. They need to sit back and wait and see the impact. Now, that number today is helpful. I mean, it could reverse next week. It could be revised away. I don't know. But a run of jobless claims prints like that, I think, would be a really loud and clear warning signal to everybody that you can't raise rates by that much and have no impact. But predicting the timing and the extent is very difficult. But we've never seen the US raise rates by 500 basis points and not have a recession eventually.
We get thrown off the...
Yeah, well, this time is different, bro. Okay, it's different. Anyway, so I think now we've got to talk about Binance is going to say I have seen what Binance has alleged about Gary Gensler. I've been paying close attention to it. It is some of the juiciest clickbait you could possibly talk about. But I don't know. I mean, I don't know how much I trust either side about if these allegations are true or not. So it'd be interesting. All right, let's go to. We got to talk about the $25,000 Tesla. Now we got to talk about the $25,000 Tesla, because the $25,000 Tesla, it may already be here, which is remarkable because Tesla's supposed to be clearing their Model 3 inventory in anticipation of announcing Project Highland and revealing Project Highland, which would be the Model 3 refresh, which they're talking about announcing and revealing, or at least showcasing in China. And this Model 3 refresh is supposed to, or deemed to be, something that's going to increase margins for Tesla, increase desirability of the car. Who knows? But what's fascinating is that today, depending on where you live, you could potentially already get a $25,000 Tesla brand spanking new, which is mind-blowing. And I'll show you exactly how to do that. But as far as a Tesla investor, what I really want you to think about is why the HE double hockey sticks is Tesla not advertising this. This is very important, because when I show you that you could actually get legitimately, I'm not using fuel savings in this calculation, a Tesla brand new for $25,000. Well, consider for a moment this website right here. This is Toyota.com. I actually highly respect Toyota. I think they make phenomenal vehicles. I think they screwed up on the EV transition. That's why they canned their CEO, Mr. Toyoda, with a D. Anyway, they canned him to get to somebody who's actually going to transition the company to EVs. They also have sandbagged the idea that people want autonomy in their cars. I'll tell you, there's nothing like autonomy in these cars. They are so freaking good. When you can actually get your commute back and do something productive, it is so nice not to have to sit there and actually drive. Mostly because even though you're paying attention to the car and supervising the car, you're eliminating the stress of having to actively be that driver, right? Now, let me show you what not to do in a vehicle. What not to do in a vehicle when you have full self-driving on, like I happen to have in my Tesla, which this would never be my Tesla. But let's just say you had full self-driving on, and let's just say you had a laptop stand right here, and let's just say you had, the Doomberg right here. And then let's just say you were also at the same time watching Bloomberg TV because you had Direct TV also set up on your phone. And so your phone was playing TV as well, and while the car was driving itself. Let's just say you could potentially be more productive. This would be very, very stupid because you could get pulled over. But of course, you know, not that the car would also potentially have a radar detector to try to minimize this. But again, this would be very stupid. You would not want to be that guy doing this. So anyway, let's just say when you're more productive than every other jerk off trying to compete for your real estate deals or whatever, well, you know, you might be able to write some offers a little bit quicker than the next guy. So going back over here to the Camry buyer, which remember, my first vehicle was the Toyota Prius. I drove that thing for like 7-8 years. It's great. I want to remind you that even though the starting price here is $26,000, usually when you actually build this crap out, you're going to be paying more. I mean, you want the hybrid version, you're looking at $24,000 or $34,000. Wow, these actually get pretty expensive. You only get 28 city miles per gallon. If you're over here at the basic LE. But again, when you actually look at probably the inventory here, if we search the inventory, you're probably not going to get something around 26. Although some of these are starting to sell for a little bit less than MSRP. You know, maybe you could get your Corolla over here if you really want the Corolla, which was actually my childhood car when I grew up. See, look at this. Sale pending. Here you've got the actual inventory. You're looking at 30 grand as the only actual inventory to get in here. And this is distance. Let's go price low to high. What's the lowest I can get? The lowest I can get on existing inventory in my area right now is 29. So that's $4,000 more than the Tesla. That's insane. But wait a minute. How could you possibly get this for $25,000? Kevin, it says $40,240. Well, first thing that you're going to consider is that you're going to get $7,500 back now from the federal government. So you're looking at $40,240 minus $7,500. You're looking at $32,740. Now you could get loot box credits or up to another $1,000 by getting a Tesla referral code, which if you don't have one, you could just type into your browser here, metkevin.com/Tesla, and you could use my referral code if you want. And when you go to that, you could see there, earn rewards with Kevin's referral. You win, I win, whatever. Hey, look, Kevin has made 101 referrals. Cool. Okay, so now how do you get this to $25,000? Well, one of the ways you can get it to $25,000 is by evaluating your state credits. In California, you could get up to $7,500 for an electric vehicle, but you have to apply for this, and there's a limited amount of this money available. So you'd have to go to cleanvehiclerebate.org, and you submit an application within 90 days of the purchase or lease to be eligible for a rebate. And you can evaluate what these tax credits are like in your individual states based on what your individual state is willing to provide. In the case of California, as long as you make less than $300,000 for a joint filer, $204,000 for HOH, head of household, and $150,000, actually, I'm pretty sure it's $135,000 for single filers, you're eligible for the full credit. Obviously, you could read the terms and conditions over here. And there's some other restrictions, income verifications, household size, blah, 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 blah. You can evaluate that on the California website, as well as reviewing eligible vehicles and funding requirements and otherwise. But now all of a sudden, you're potentially taking this $40,240 car minus $7,500, minus $7,500. You're potentially looking at a Tesla for as inexpensively as $25,240 for a brand new Tesla Model 3. Even if you can't get that $7,500 from your state, though, you're looking at about $32,000 for a Model 3. Now, what's fascinating is what a lot of people will do is they'll evaluate the Tesla car payment versus another car payment. Generally, what I recommend people do, and we've been evaluating this lately, is generally what I recommend people do is for now, skip the full self-driving. Just get yourself the enhanced autopilot, especially if you do a lot of city driving. I'm sorry, if you do a lot of highway driving. If you do a lot of highway driving, you could just get away with the enhanced autopilot. And now let's go ahead and evaluate what it would cost on a monthly basis. So with 10% down, you're looking at about $710 a month. That's a lot of money because the interest rate is about 5.69%, right? So let's evaluate how much of that would be going to principal. So to do that math, what you're going to do is you're going to take the purchase price of the vehicle. Now you're going to be borrowing against the entire original purchase price of the vehicle. So you're going to be borrowing against this $40,240 at 90% since you're putting down 10%. So call it a $36,216. And now let's run the math of how much your interest per year is going to be. Your interest per year is going to be about $2,000. So if your interest is about $2,000 per year, you're paying about $1.71 in interest. That means your principal pay down is actually $539 per month. So out of the $700 that you're paying, $539 of it is going to actually paying down the value of the car. That's basically money going towards your asset. Now it is a depreciating asset, but the good news is you're getting a check back from the government for $7,500 on the federal basis and $7,500 potentially from California. And the Biden administration just confirmed that the Tesla Model 3 qualifies for the full $7,500 because Tesla rejiggered their supply chain, smartly so, to basically create a tax deduction with basically taking advantage of what the government's going to provide via the Inflation Reduction Act. Now, the crazy thing about this is this vehicle is absolutely amazing. I personally do not believe the Model X, which I own, or the Model S, which I own, are worth it. If you are going to step up from the Model 3, I think the Model Y is the most you should spend. Cars are depreciating assets, but the Model 3s and the Ys are the safest vehicles that exist on the roads. They are phenomenal in terms of how quickly you can charge them, how far you can get. I'm a big Tesla bull. I think these cars are great. There's once you drive a Tesla and you actually use the self-driving features, there's no competition, at least not yet. So I'm a big fan of these. I would not spend more money, though, on the S and X. I don't think it's valuable. The only reason you would do that is if you're kind of wanting to pull the, look at me, I have a more expensive car. Or you want to go a little faster on launch or whatever. But I'll tell you, that's fun to show your friends and stuff. But beyond, is it worth another 50 grand? No. So Model 3, a Model Y, becoming substantially more affordable thanks to tax credits. This doesn't even consider your potential fuel savings. I understand the legacy argument that everybody makes on the electric vehicles that, well, got to plug it in somewhere. Guess where that electricity comes from? It comes from coal. I here am not making an argument about electricity not coming from coal. In fact, I'm not making a green argument at all. I'm making a simple argument. Now, this is a very affordable car that's very safe, and it'll drive for you. Now, you should be safe with how you have it drive for you. But there's some limitations. Obviously, you got to pay attention to what the darn thing is doing. It's a lot of the stuff is in beta, so you want to be careful. Yahoo News notification. Tesla considering building $4.8 billion factory in Spain. Wow. See, that's smart. That I really believe they should just build factories. I've called it copy and paste in the past. I'm not calling it that anymore, mostly because what we've adapted that to is, yes, we're going to build more factories, but we're going to build different factories, right? And let's say in Northeast Mexico, we'll do the $25,000 car or more inexpensive car. Maybe in Nevada or whatever, we'll do our some of our batteries. In New York, we'll do some of our solar panels. In Europe, maybe we'll do something else. Whatever. It's not bad. But if that ends up being true, that notification, which would I don't think you're feeding me BS here, but yeah, that's great. The problem is it is going to lead to more of a capex capital expenditure for Tesla, and that is going to burn their balance sheet more than it's already been burned. And so there are some shorter term risks in terms of cash flow needs for Tesla. But in terms of people buying these cars and now what you can get with tax credits relative to the price of these other vehicles, I don't understand how it makes sense to buy yourself a Camry for 30 grand when even without state tax credits, you're basically getting a Tesla for the same price. And then you have the future proofing of the over-the-air updates and all of the potential full self-driving features if you want them. The other option for FSD is just pay for it monthly rather than just pay 15 grand, which I think is a little high. Just pay monthly, like either $99 or $1.99 for it, and try it out. I personally think Tesla should offer free 30 or 60-day trials for FSD to make people realize, oh my gosh. What I actually really like doing is I like turning it on when my wife is in the car. I love turning things on when my wife is around. But anyway, what's remarkable is she used to not like autopilot. Now she's like, damn, that's actually nice. I wish my Toyota Sienna had that. And then I'm like, well, Lauren, we can get you a Tesla. And she's like, but Kevin, I need the space. And that's the one thing I actually agree with her on. The Model Y is not as spacious as a minivan. And we've got twins coming. So quite frankly, even the minivan's not going to have enough room. And so I will finally be able to upgrade to my dream of a vehicle, the Mercedes Sprinter van. I cannot wait. However, I will be very disappointed in driving it because it won't have full self-driving. Now, if Tesla would come out with one of those, I'll buy 10. And that does it for my segment on Tesla. Hopefully you enjoyed. Oh dear, some of these comments are funny. Okay, what do I got here? What is this? Thank you for the time and content. If you have time, I would appreciate your thoughts on the craziness around microvision. Isn't that like a meme stock? I mean, I remember back in the day when microvision was cool. Microvision was cool because of the forward-facing LiDAR, which is the most important for a part of LiDAR, which you could have in the mirror of the camera. I remember covering this stock a long time ago, years ago. But the problem is they canned that project. And then people are like, oh, but it's going to be part of the Microsoft Halo lens. I'm like, that's fantastic. Halo 2, whatever, who cares? Where are the mainstream products? And then they canned the forward-facing LiDAR, as far as I can recall, on the mirrors. And I'm like, what the hell? So, maybe there's like some memeness potential. But in terms of like actual products, I don't know. I haven't been paying attention to them. Now, it does look like it started memeing again recently. My gosh, yeah, it has. It just went from $1.82 to $8. I mean, that's like the definition of a low float meme mover. So from a fundamental point of view, I don't think it's a play unless something is substantially changed. But when you take a company from like a $300 million market cap to a $1.3 billion market cap, thanks to a meme movement, yeah, that's pretty impressive. Trade it, don't hold it. Not financial advice, just generic suggestion here to be careful, because when the volume dries up, it'll probably go back down. All right. Somebody here says, I demoed the Model Y long range, the slowest Tesla, still felt insane. Yeah, it's remarkable. My first experience really with like 0 to 60 and stuff like that was in my dad's girlfriend's BMW convertible at the time. And it was just a Series 3. But it was still, back then, when I was a kid, we were broke and like dead broke. We'd basically lost our home to foreclosure. That sucked. Cars were getting repossessed. I basically went to school in a rape van. Those like the white work vans, the what are they? Like, I think they're like the Ford E's, the E series vans. And I'm not talking about electric. They're definitely not electric. I'm talking about like the 8 mile to gallon, like it's got like no windows and the slider on the side. Yeah. Darn thing got repoed on us. But anyway, so when at the time we tried my dad's girlfriend's BMW convertible, I felt like a king when she let me drive that to school. And that was like a 0 to 60 in like, wait for it, 6.9 seconds. The Tesla Model Y is like, 5-something seconds or whatever. But 6.9 back then was like, hell yeah. When I was a police explorer, we would go 0 to 60 in the Ford Crown Vics in like 9 seconds. And we're like, that's a turbo, man. This is the turbo. And it was 9 seconds, 0 to 60. And the Beamer, relative, was 6.9. It's like, this is so cool. But then that lady found out my dad didn't have any money and she left him. True story. So I didn't get to ride that Beamer convertible anymore. Anyway, so yeah. Okay. Long story short, Teslas are fast. EVs are very fast and they're pretty cool. All right. Now what? I don't know. Let's see what the pre-market's doing. So in pre-market, Tesla's up about a quarter. Dollar General up 3/4, 3/4. Trade Desk's up about a quarter. Trade Desk's been having a move here. Trade Desk's been doing well. When's Intel going to do that? Intel's like that dead dog where it's like, come on, man, do something. Like, get up and do something already. Most of the market's actually green after these jobless claims. The exception of cybersecurity, down about 0.2% over here. Yeah. So, somebody literally is saying here, check the price of tattooed chef. Hey, it's approaching our support line. Look at the support. This support's been here for years. All right, let's listen in over here.
Kind of going back to that, what if we have no landing, soft landing? I mean, we are still expecting a mild.
Here we go again. The no versus soft landing talk.
Early next year. We turned tactically cautious on small caps in March after SVB, and we've been kind of watching the credit backdrop and banks and earnings. Small caps obviously do still have that much larger weight in the regional banks, where there is, risk of further regulation, multiple overhang. But I think, you want to be selective in small caps. I do think longer term, if you have a long time horizon, the valuation opportunity here is, really attractive. And the bounce off these lows from a, positioning and sentiment perspective certainly makes sense to some extent, since we've seen investors have been, just huge sellers of small caps this year in the flows data. But you still have about a third of the index that's non-earners, so we would definitely be selective within small caps at this point.
Okay. So when you say selective, give us some ideas of how you'd be selective. And I think you're saying don't buy the index.
Well, I think, the Russell 2000, if you compare it to an index like the S&P 600, the S&P 600 is going to be a much higher quality small cap index, has much fewer, stocks with no earnings in it. I do think that, we've seen a rally within small caps this year in some of the lower quality stocks, parts of.
Oh, thanks for saying this. Somebody here writes, Ellis here writes, played Bill, Dave & Buster's, Intel, and Etsy. All been really solid trades, thanks to the course member live streams and you. Why, thank you. That's it. We need like a commission. Or like, check out the courses, link down below on building your wealth. In case you're not an OG, that's like an OG gamer. That's Age of Empires conversion, like sound effect. Anyway.
Have looked ranked relatively well in our work in both large and small caps. We do think, we're in a more CapEx cycle after companies hadn't been spending for a really long period of time. And you have a lot of drivers for that: reshoring, automation, ESG. So some of the more old economy sectors can actually benefit, and many of the domestic small caps are beneficiaries of that.
Okay, we're going to leave it there. Jill, thank you. Appreciate it very much.
Thank you.
I want to bring you an update right now. A lot of folks looking out into the skies and breathing the air this morning.
Should I go to New York today?
What is happening? We have also some news on flight delays all throughout the Northeast. The FAA adding a ground delay now at Newark Airport in New Jersey. The average delay just over about a half an hour. That's in addition now to the ground delay that's taking place at LaGuardia Airport. And there's another ground delay, or I should say a ground stop in Philadelphia. You're looking at a lot.
We can't land in this crap. I can't fly into this crap.
But that's about it. There you're looking at Philadelphia, I believe, the Philly airport there where the ground stop is taking place. Road warriors and families and others trying to make their way around the country going to be delayed today. And they're going to have to keep an eye on FlightAware and all sorts of other places. But here we are. folks wearing their masks all over again.
Yeah, I know somebody here wrote, good thing you have your own jet. It's not that easy, okay? Like, this, coordinating this stuff is a pain in the butt. And it's like, do you want to put your own plane in that trash? I don't know. I'm not a pilot, and I'm not going to become a pilot. People are going to stop recommending Kevin be a pilot, and it's not going to happen. I would be a horrible pilot. I'd be like, oh, what's over there? Oh, yeah. Or worse, whatever. It's bad. Or I could be drinking coffee while flying. You never know. All right, there's actually a funny piece in Bloomberg right now I think we got to talk about. I actually love this headline. This headline right now is, the bears are running out of worry. And I think it's worth analyzing because they actually do this. Take a look at this. I love how they wrote this down. Regional banking crisis, checked off. Debt ceiling, checked off. Upside risk for oil prices after OPEC plus supply cuts, checked off. Sure, we still have U.S.-China tension, war in Ukraine, threat of commercial real estate losses, and a plunge in real estate activity. And of course, add to this the liquidity argument, which we already broke apart as probably being a nothing burger, given that the 6-month bills right now are trading for somewhere around 5.4%, which gives you a premium over the reverse repo facility, making it make sense for this not to be a liquidity drain, long and short of it. This is relatively correct. There's little bit to be horribly worried about right now. You could throw on there maybe earnings recession, but there is a lot of pessimism right now. But you are then seeing those recessionary fears rotate down in terms of estimates. We're seeing less and less of these estimates now. But another thing that I wanted to look at is that there's another piece, and that is, quote, how a Fed rate pause is likely to morph into a cut. Pause talk is in the air, with the market pricing in only about a 30% chance of a rate rise at the next meeting before further hikes. But the world and the Fed could look significantly different by late summer as risk calculus starts to favor looser monetary policy, not actually tighter policy. In fact, when you look at history, this article here via Bloomberg suggests that the Fed very rarely raises rates again after pausing when policy is already restrictive. Jerome Powell already made it clear to us in the last 2 press conferences from the Fed that what? Policy is already restrictive. Okay, so history tells us the Fed rarely raises again after pausing when policy is restrictive. That would be consistent with the Fed not wanting to repeat the mistakes of the 1970s, where they paused and restarted and paused and restarted, leading the markets to price in that the Fed was clueless. Inflation is also expected to continue falling over the next few months. One of the reasons I believe you should follow me on the Twitter is because I tweeted something yesterday that I actually think is relatively useful. You ready for this? Imagine that. I actually tweeted something useful. I feel like I'm insulting myself. Anyway, I thought this was very interesting. Listen to this. Wage tracker put together by Indeed.com shows wage growth falling rapidly. This is great news for minimizing services inflation, since wage growth pumps up services inflation, which is the leftover sticky part of inflation. But not only that, wage growth is a strong leading indicator. And it's worth noting that the peak of wage growth was right here. See the peak? A peak means the top of the chart, right? Where was the peak? Well, the peak perfectly aligned with January of 2022. But folks, where was peak inflation? Peak inflation didn't come until 6 months after that. Peak inflation came in June of 2022. That means there is a 6-month lag time in when falling wage growth hits inflation. Well, look at wage growth falling off a cliff over here. In fact, it's dropping at a faster rate than it previously was dropping, which is an indication the Fed does not need to further tighten monetary policy because you have enough leading indicators suggesting we're Gucci here. In English, this is good for stocks and good for workers. you still make more because it's not negative wage growth, right? Now, what else do we want to consider when it comes to history of the Fed? Well, here it says, it might be a surprise, but it's rare indeed for the Fed to retighten policy after pausing. It's even more rare for them to do it when rates are more restrictive. The chart below, I'll pull it up in a moment, shows that in instances like this since the 80s, it's unlikely and generally unprecedented that once the Fed pauses, for the Fed to actually start hiking again. They give this chart, which is a little bit of a convoluted chart. It's just worth considering that you did have the Fed pulling that kind of nonsense in the 70s, but that's the kind of stuff that actually led to the Fed basically unanchoring inflation expectations and causing more pain than they should have, which is not good. Now, we could look at several measures about how restrictive rates are. Probably the biggest thing to look at is the fact that the yield curve is more inverted than it has been in the last 40 years, which is your difference between like the 2-year and the 10-year. And we're pretty dang inverted. Now, a lot of people say, but the earnings recession will come from the steepening of the yield curve. And that may indeed be true. But it is a suggestion that if earnings start coming in soft and we do end up trending towards a recession, that we have all the more reason while inflation falls to end up lowering rates, not raising rates. And that's important. Now, what's also worth considering are what are inflation expectations doing today? So let's take a quick look at that. And we will go to the 5-year break even to see. We'll also be getting University of Michigan sentiment data next week on inflation expectations from the consumer's point of view. But right now, inflation expectations on a 1-year basis are not quite at 1-year lows, but they're relatively anchored around 1-year lows. And on a 5-year basis, we're obviously elevated from COVID time, but we're doing just fine. Take a look at this. If we jump in over here, we've got this is your 5-year decline of inflation expectations on the right side. Still above where we were back in 2019 and 18 when we were cutting over here, but clearly a sign that we're trending close to the level of cuts again. And if we look at the next shot here, we get the last 1 year of inflation expectations, also relatively, trending down here. I mean, the trend line is clearly down. It's very volatile, though. It moves up and down. You can see we seem to be quite anchored over here in May, though. May and June, very, very anchored compared to what we've seen previously, which is fantastic. Once again, all the more reason to slow down this idea that the Fed needs to go towards rate hikes, which is actually great because when you look at the Fed rate monitor, especially after the jobless claims we got this morning, which came in a little hotter than expected, which is a sign that the Fed's policy is working. Continuing claims did fall, though, which is a sign that people are able to get their new jobs. We did see which brings the labor market back into balance, which is good. We did see the rate monitor move now to a 73.7% chance of a pause in June. That is a delta of about 11%. In other words, we've now seen about an 11% shift in whether we're going to have a pause or not in favor of pausing. You also now have a less than 50% chance of a hike in July. That was slightly more than 50%. Just a few days over the last few days. So something else to consider. But long and short of this, we've already been looking for more bearish arguments to try to understand what is going to bring this market back down. And I think it's really important to consider when I've talked previously about the Nike swoosh recovery. I've called it a volatile Nike swoosh recovery. The Nike swoosh, to really see the picture of it, you have to go out on the week chart on Webull. This, by the way, is Webull. You can get 12 free stocks if you want to use this platform. Just go to metkevin.com/free. Make sure you use that paid promotion link. It supports the channel, but also gives you free stocks, and you get to use this platform. But anyway, this is just the beginning part of the swoosh, right? This is the little part of the swoosh. And my expectation is over the next 10 years, we see this move vastly to the right side as artificial intelligence and innovation and a lack of inflation really explodes our economy. We go back to growth from a low. But in my opinion, in order for us to really break down to lows, and we'll have volatility here. we will bounce around. I mean, you've even seen that in just the last few days, sort of this retracement here to our Fibonacci level here. We're going to have volatility. I wouldn't be surprised if we do get some tests here lower again. But whether that's 330 or 311 doesn't really matter, although it's going to take a catalyst. Do I really think we have a chance of going back down here to the 250s? Unlikely, because this was pricing in Paul Volcker. A lot of this low era over here, mid 2022, towards the end of 2022, was really pricing in this fear that you are going to see Paul Volcker absolutely destroying this economy and throwing us into a horrible recession and if not depression, because frankly, once inflation is out of the bottle, the genie's out of the bottle, so to speak, he doesn't want to go back in. It's a bad analogy though, because inflation isn't a genie. It is something that when you stop printing money as rapidly as you were, it goes away. It ends up proving to be transitory. And yeah, Max, you're right. People are still thinking things are worse than 2008, you say here in the comments. But that's fantastic. The best time to invest is when everybody else is like, shit's going bad. In fact, it was so funny. One of my staff members is a total bear, and I love it. I love it when people have different opinions of me. I don't want people having the same opinions as me. I want people being like, but Kevin, what about this? It's great. Like, if you want to work for me, just have different opinions for me and then send an email to jobs@meetkevin.com, especially if you have a JD and no experience in law. I know that sounds crazy, but we want somebody with no experience that we can kind of mold to be our in-house counsel, and then we can do whatever we want. But anyway, send an email to jobs@meetkevin.com or whatever. But anyway, so what's remarkable is we were standing outside debating the other day, and then a neighbor walks by. And we respect our neighbors. We like our neighbors. They're like, Kevin, man, I'm thinking about going in on gold, man. I'm nervous, man. Things are bad right now. Should I gold or silver? And I'm like, I don't know, man. I'm not that bearish. And they're like, I don't know. Things are bad, Kevin. Things are bad. And I've always told myself, when people on the street, quite literally, well, he was on the sidewalk, but we'll call it the street. When people on the street are like, I don't know, man, I need to get myself some more of that gold, I'm like, I'm glad I'm buying stocks. So anyway, if you want some more deep dive fundamental analysis, make sure you're part of the deep dive fundamental analysis live streams we do every single day. The market is open. You can join any of the programs linked down below. You get lifetime access to those courses on building your wealth. We have different courses, so you can pick what class do you want. You want lectures on real estate investing? How about stock investing? How about making more money and LLCs and liability and insurance for your business or your startup or leadership or communication, whatever? We've got an option for you linked down below, so check those out. Maybe you're already in real estate and you want to learn more about investing or property management. We got a course for do-it-yourself property management and rental renovations as well. Big money saver for people. So we're very excited about all the different offers that we have. And we really think we provide 10 times the value in the courses that you actually pay for them. And we're satisfied with that because, hey, providing a digital product, we provide you my time in the live streams for Q&A and analysis. And we think it's phenomenal for everyone involved. So hope to see you there. But yeah, when it comes to the economy here, I don't know, it's very difficult right now to find serious bear sources, which eventually will turn into, the contrarian play is going to be being bearish again, but we're not there yet. Any update on the defunding of the dollar? I think the dollar fears, at least in the short term, are quite overblown, but we'll see. Do you own any physical gold and silver? Well, the correct answer, given that people would know where you live, would always be absolutely not. Don't worry, there is nothing here for the taking. And with that, I'm going to jump over to the course member live stream after I make some coffee. See you all over there. Thank you so much for enjoying Meet Kevin Report episode 101. And we'll see you in the next one. Goodbye.